In this interview, I'm going to be talking to Michael Sambasivam, who is a senior analyst with Investors for Paris Compliance. They just lodged a complaint with the Alberta Securities Commission about net zero claims made by Cenovus Energy, which is an oil sands producer, and by Enbridge, which is a pipeline company. Has enormous amount of pipelines all over North America. So welcome to the interview, Michael.
Thank you, Markham, for having me. Always appreciate you.
Well, thanks. We want to get into this because I have a vested interest in this, if you will. In 2019, I wrote a book called The New Alberta Advantage: Technology, Policy, and the Future of the Oil Sands. And I essentially bought all of the claims that were made by the oil sands companies because at that time they were telling me, and this would be 2015 to 2018, they were telling me that in global oil markets going forward, they needed to be cost and carbon competitive. They had to get their emissions intensity per barrel down so they could compete with Norway, they could compete with the Saudis who have very low emissions intensity. And they haven't done that. They have not done it, and they kept claiming that they would do it, from 2019 onward. And so when I heard that you had brought this claim, I was not at all surprised. But what was the motivation behind it?
Yeah, the motivation behind it was ultimately that we viewed a lot of the net zero and sustainability related claims coming from Cenovus and Enbridge as not telling the whole story. Uh, Ultimately, I think most Canadians, in having seen marketing from up and midstream oil companies over the last few years, there's been this sort of connection between oil sands and this sort of vague terminology surrounding net zero. I mean, prior to C59, we'd see Pathways Alliance advertisements all over the place suggesting that, oil sands are on a pathway to net zero. What we found, having digged through these sustainability reports and these emissions disclosures, was that the definition of net zero being used by Enbridge and Cenovus, being examples in this case, did not line up with accepted best practice terminology of net zero. So on one hand, we have the operational emissions that are being targeted in these commitments, which represent sort of in the 20 to 30% range of total emissions. And there's all the downstream emissions. So that is the combustion of these products by the end user. And that combustion that represents the bulk of emissions represents a really significant chunk of the risk being held by these oil companies. Because ultimately, as global buyers are disincentivizing high emissions fuels, those end use combustions are a really significant part of what they're going to be caring about. So where we're seeing these, incentive shifts through the energy transition, genuine net zero means, a pathway to getting off of these high emitting fuel sources, as opposed to just cleaning them up on the margins.
Yeah, I mean, they're called scope one and two and three emissions. And
Yeah.
scope one is the direct emissions created in the production of the product. And scope two is the transportation and processing and so on. And scope three is when you actually combust the oil or the gas. And
Yeah.
the scope three has always been the major problem because, these companies would argue that they don't have control over how their products are used once they're sold, whether they're
Yeah.
put into an industrial process with no emissions, or they're burned, in which case you get all the emissions. So that debate has been going on for years, and we're not going to resolve it today. But the problem here is that emissions continue to go up, and there's a claim that I didn't see in your report, but I've railed against before in videos and on social media. And that is the industry will say that its emissions are falling, and the Alberta government
Mhm.
will say the oil sands emissions are falling. And what they mean is emissions intensity per barrel are
Yeah.
falling, but while absolute emissions continue to climb because they produce more of it and the extra supply overwhelms the improvements in the emissions intensity.
Mhm.
Was that part of is that part of your claim?
That was not part of our claim, because ultimately we view Cenovus and Enbridge as being, having looked at their sort of capital expenditure trends and their transition plans, we don't believe that they're on track to actually even meet the limited commitments that they've made in the first place, but they would be able to meet the commitments that they've made while not genuinely achieving net zero in ways that it has been advertised by them. We've seen across a lot of these disclosures net zero claims being made without prefacing those claims that this is a scope 1 and 2 commitment only, and we've seen insinuation that there's alignment between these commitments and global best practices and Canada's net zero commitment, which just is not supported by the facts. But I think that ultimately what you pointed out is helps support our claim in so much as total emissions can go up across all parts of the supply chain, but if supply keeps, or sorry, apologies, emissions can go up across all parts of the supply chain while being reduced on a per barrel basis, but that doesn't mean that they're actually reducing their emissions.
And I would imagine that one of the reasons why you filed this with the Alberta Securities Commission
Yeah.
is that they're misleading investors. That's your claim, correct?
Yeah. Yeah, that absolutely is our claim. And I think it's especially important because to investors, those scope 3 emissions are really significant. That's where the bulk of the demand side risk is represented on their balance sheets. The question at the end of the day is going to be, is there going to be a buyer for this oil? And as we see, a plateau incoming, and when that is coming is determinant based on what reports you believe, but everyone does project an impending plateau. When that plateau then tends to slope down, there's going to be this question of, are sellers going to be able to find buyers for that oil? And those scope 3 emissions represent the end use and the buyers. So where there's still significant chunks of scope 3 emissions remaining by these oil sands companies, that represents risk for investors, which is not being mitigated by any sort of plan to reduce that. A genuine net zero commitment would mean developing a plan and aligning capital expenditure with lower emitting sources of energy.
A clue to where the industry is going with this is to watch what the Alberta government says. Now, Premier Danielle Smith was an oil lobbyist registered with the government between 2019 and 2022. And she is, to say she's pro-industry is to understate the case. And what's happened under her government since she became premier in 2022 is that they have been pushing back against that. And what they've been arguing is in fact that there is going to be plenty of demand. They give the OPEC view of things. They say that there will be demand in petrochemicals, which is not is a suspect claim. It's unlikely there will be. And I happen to read the modeling that you were talking about, the reports. The modeling, there's lots of it out there. I could, off the top of my head, give you 15 agencies. And the bulk of them would argue that oil demand is going to peak in 2019, 2030, and we'll probably see a decline as early as the early 2030s and maybe the mid to late 2030s in the more extreme cases. And this is a huge problem for the industry, and so they try to shift the conversation away from it, which you could argue misleads investors.
Yeah, absolutely. And I think part of that is industry trying to, gain public support to try to find, subsidies on the ends to try to, find that little extra bit of margin to maintain viability. And that's part of what we've seen from Pathways Alliance. Ultimately, their big marketing campaign was to try to get big public buy-in for a multi-billion-dollar carbon capture project that would reduce their capital expenditures and allow them to spend less money on their climate transition plans. So I think this view that there's going to be sustained demand is a really, really risky bet. More realistically, Canada needs to start hedging its bets, and we have all sorts of alternative industries that are looking to see really massive growth throughout the energy transition, and doubling down and tripling down on public dollars into an industry that is trying to prop itself up is inherently risky.
I want to tell another story that's relevant here. And this comes from Eric Denhoff, who was
Mm,
the Deputy Minister of Climate, and Environment and Climate Change under NDP Premier Rachel Notley
mm.
around 2016, 2017. And he told me this story on the record. You can find it on our website, energymedia.com. And the story is that he and the Premier, Rachel Notley, went to New York and to Wall Street to meet with these big investment houses. And one of them, they met with a VP. So, they had senior people at the table. And the VP looked at them and said, I have a problem with my investors uh, getting interest in investing in your oil sands. He said at that time there had been a campaign from around 2008 called the tar sands campaign, and it had been attacking the industry and turning public opinion against the oil sands. And they said, oh, our investors now are very skittish. They don't want to be involved with you. I need a narrative. That was the key. He says, this isn't an issue about fighting over facts. I need an alternate story to the ones that the tar sands campaign is telling. And of course, a year or two before, the Notley government had introduced the Climate Action Plan, and they had introduced industrial emitter carbon pricing and consumer carbon pricing, and they had undertaken some other efforts. And the VP looked at them and said, that's perfect. All I have to do now is tell investors that the government is bringing in climate policies, and your concerns about rising emissions from the oil sands now has been taken care of, and that investment will flow again. And my point here is that if you think that investors are informed and they go through, they understand these issues, they don't. They rely on people like this Wall Street bank investment house to tell them, give them advice and tell them whether or not they should invest. And it's all based on narrative, not data, not evidence.
And that was a big part of why we ended up filing this specifically through the Alberta Securities Commission, as opposed to going to the Competition Bureau and using the avenues available through C59. Was just that, we ultimately believe that securities regulators have an obligation to, mandate truth in advertising and truth in disclosure. Public knowledge surrounding climate terminology, especially as it changes so quickly from year to year to year, expecting the public to understand the difference between scope 1 and 2 and scope 3 emissions is a really high burden. And additionally, there's this burden that's placed via C59 that private groups should be the ones policing these misleading claims. Ultimately, we found that there are, laws on the books. We cited lines from the Alberta Securities Act, staff notices from the Canadian Securities Administrators. There are laws on the books which suggest that provincial regulators have an obligation to police these misleading claims. It should not be on the public to have to parse through every single sustainability disclosure to figure out, okay, are my investments genuinely in line with net zero? Are they, genuinely planning for really significant shifts to energy demand patterns, or is it all marketing? So that was ultimately the reason that we thought it would be good to have a precedent on the books that Canadian corporations are expected to be honest in their climate marketing.
Right. There are some other issues here. And again, I say, Energy Media has reported extensively on this, and we've been part of the uh, discussion for a long time. And I want here's another insight for you. The industry views emission reduction very differently than the government. The Canadian government has always been was part of the Paris Agreement. It's committed to Paris climate emission reduction targets. And the Trudeau government brought in any number of pieces of legislation from 2017 to recently to reduce emissions, including consumer carbon price that now has been ended. But here's the point: the industry didn't want that. It didn't
Mhm.
like it. It did agree with carbon pricing initially, then withdrew that support as time went on. But what it always said, if you go back and you look at climate action reports from the Canadian Association of Petroleum Producers, CAP,
Mhm.
they always said this should be a technology-led process, not a policy-led process. And what they've always believed is that sometime in the 2030s, maybe it'll be the early 2040s, technology would emerge that would allow them in one fell swoop to decarbonize their operations. And small modular reactors would be a very good example of that. And I'll explain why. In the oil sands, most of the emissions come from burning natural gas to create steam, which then
Mhm.
either gets used on the mining side in their processing plants or in the SAGD side, they pump it underground to loosen up the bitumen so it'll flow. That creates the bulk of their emissions. If you were able to put a small modular reactor right beside where you need that steam, right beside your boilers, and you could generate it with a nuclear electricity, you would essentially have a zero emission way of bringing down a clean way of bringing down your emissions, and it wouldn't take long. You just build a reactor, maybe it's 5 years, whatever they think it was, and boom, your emissions are reduced to a small fraction of what they are now. And so a lot of this, from my point of view, is the claims, the strategies, the all of that, the public is to push back and keep the government at bay
Mhm.
while until these technologies are available, then they invest in them and they're done. They've fixed their emissions problem. I don't know. Did you see any evidence of that when you were preparing your claim?
I think we do see. I haven't read that claim specifically, but I believe it, and I think that is sort of in line with what the mandate of oil and gas lobbying has been in the last few years. There's been a bit of a mindset of, trust us, we're decarbonizing. You don't need to place an emissions cap. You don't need to place a carbon tax. Just let us do what we're doing, and we'll decarbonize. Trust us. And I think that's not necessarily supported by the actual lobbying that's being done. There hasn't been this big push from oil sands companies for the Canadian government to go invest in alternative energy sources. There's been no mandate of the lobbying associations to, really push for new technological development. It's this, I think, appeal to the Canadian public that something's going to happen. We believe that the technology of the future will allow us to keep doing exactly what we're doing, and we're sort of coming to a point where we don't really have the time to do this. And I think I view that from sort of 2 points. On the one hand, from a purely climatological perspective, we're running out of carbon budget. We really don't have the time to sort of sit and wait and hope that something comes along that is going to save us all. But I think another really important perspective here is from the angle of the health and wellness of the Canadian economy. We're so invested in our resource economy, and specifically oil and gas. And if the Canadian government continues to incentivize, new oil and gas production, especially with the new major projects panel that's being put together, we're very likely going to see some new big push for public funding towards major oil and gas infrastructure projects. And we're losing time, and we're losing time to a lot of our other global competitors, which are increasingly seeing that investment in critical minerals, investment in renewable power, investment in energy transmission are more economically sustainable alternatives to be putting public dollars in.
I want to bring up another issue here, why the oil companies behave the way they do.
Mm.
So, because there have been emissions intensity per barrel reduction. So why is that? If they're correct, if you're correct in arguing
Mhm.
that this is kind of they're pushing back and they're not really sincere about why they're doing. Why are emissions intensity per barrel falling? Well, there's an explanation for that. And that is that the industry for the last 10 years has been very focused on efficiency improvements. The
Mhm.
more efficiently it can produce a ton of steam, the more it lowers its costs
Mhm.
and becomes more competitive in global markets. And so, and I was told this story by three different sources, and they confirmed it. So let me tell you this. When every year when the budgets come forward at an oil sands company, so you get the various departments, they say, we want to spend X amount of money.
Mhm.
And you come to the sustainability department or whichever department it is. And the management team will look at them and they will say, if we give you $1 and you spend that dollar, how will you improve the bottom line of the company?
Mhm.
And so if you say, I will spend it to improve efficiency and lower costs, you'll get the dollar. If you come and say, no, no, we got to meet some climate targets and, and we're not going to generate any additional revenue, then you're not going to get the dollar. And so there are efficiency improvements like, Suncorp. They have a giant, base plant where they produce a lot of steam. And they went from pet coke, which is a very, very dense and emitting emission, emissions intense, and they went from pet coke to natural gas. And
Mhm.
that lowered, they became more efficient. It was actually lower cost to do that. And a side benefit was lower emissions intensity. And
Yeah.
so the industry, that's an example of what the industry will do. They will invest in things that that lower their costs. And if there's a side benefit of reducing emissions intensity, they will do that. And that's why we have seen some improvements over the last 10 years. And, I can give you the numbers, 88 kilograms of CO2 equivalent per barrel 10 years ago, sorry, in 2009, and now it's 66 kilograms of CO2e. But that's why they've been doing it. And it has, in my opinion, it has very little to do with climate ambitions or climate policy. It's all about economics.
Yeah, absolutely. And I think that sort of aligns with the other perspective that we've seen across a lot of the sort of climate marketing from Canadian oil sands companies, which is that uh, I think there's this strategic question of what is there on the books that we can do that makes sort of the biggest on paper difference while minimizing the impact that it has on day-to-day activities, which I think is the fundamentally wrong question to be asking from oil sands companies. They need to be asking for the health of the economy and for the health of their shareholders. Whether are there things that they need to do to be more robust through a transitioning economy? And I think the example that you gave supports that in some way. But I think additionally, there's this question of um, are climate actions simply just feel good things that they need to do to win over the hearts of Canadians so their subsidies don't get pulled, or is there an existential threat to their business? Does the energy transition pose an exponential or an existential risk to their business? And increasingly, we are seeing financial institutions ask this question. They are asking their holdings, specifically their energy companies, do you have a genuine pathway to net zero? And that's sort of where we were going with this complaint. I think a lot of the climate transition plans of the biggest investors are asking their holdings, what are you doing? And we don't believe that companies that are not genuinely committed and on track to achieving, genuine net zero commitments should be permissible under more broader investor net zero commitments that are being made. So I think on one hand you do see the question of are they doing this for the climate or are they doing this for their bottom line? And then there's the other question of are they doing this for the climate or are they doing this for maximization of marketing materials?
Now, there's another wrinkle here that I want to add, and this has been a big part of our work over the last year or two. And that is, it's very clear now, and you'd almost have to be willfully blind to not see it. But the North America has decided to double down on hydrocarbon production and consumption, so oil and gas. But in Asia, particularly China, China is now pursuing a strategy of electrifying its economy, both on the supply side, so the power grid, it's wind and solar and hydro and nuclear, and the percentage of coal is coming down. But the real relevant point to this argument is they're also electrifying the demand side, which in the context of oil is electric vehicles. And they're not just doing cars and trucks that you and I would drive. They're doing buses. They're doing two and three wheelers. They're doing medium duty delivery vans. They're in garbage trucks. And now they're doing class 8 long haul trucks. And so when you look at the actual Chinese oil demand modeling, they're very pessimistic. They're talking about over the next 25 years, they'll lose 10 to 12 million barrels a day of oil demand. This is like, over 10% around 10% of all demand at the global level. Now, that's one scenario. It's modeled by the International Energy Agency. But what the industry does is it buys into other modeling. OPEC has a completely different view of the world, completely different. And in there, demand goes from the 103 million barrels a day today to 120 million barrels a day by 2050. There's actually more. And this is why you see Premier Daniel Smith, you see the oil and gas CEOs, on and on and on about we want to build pipelines, we want to take more of our product to market, is because their view of the future is increasing demand for their product and higher profits, not existential threat caused by the energy transition. And they're clinging to that. It's almost a myth at this point, in my opinion, that higher demand scenario. Did that find its way into your complaint?
That did not find its way into our complaint specifically, but what did find its way into our complaint was sort of the net zero pathways that are being modeled by similar organizations. So we pointed out that one of the companies in question had referred to the IEA net zero pathways as being sort of one of the bases of their net zero transition strategy, which fundamentally just didn't align with what that transition strategy from that company actually said. If you go and flip through the IEA, the World Energy Outlook, and look at how it models, ongoing oil demand and ongoing gas demand under a net zero scenario, it's a really, sharp downturn from a demand perspective, and I think that is really significant issue. And I think we've also seen what you were talking about being really accelerated in the past few months. I think we've seen attacks on the IEA from the United States government, questioning its legitimacy, calling it a global activist group when they really do some of the best energy models, I think, on the public market today. And then I think in addition to that, we do see from Canadian companies, if you flip through their audited financial statements and look at how they see their ongoing viability, they estimate out their commodity pricing, projecting how much money they're going to be able to make in the future, how many of their wells are going to be viable. Pretty much all of them use a really short-term perspective and then just model it out using a 2% rate of inflation, which just simply fails to take into account that a lot of the diminishing demand seen in most of these models would then be associated with a drop in global crude prices. It's just not being taken into account, and it represents a really significant risk to their viability.
I want to address that in just a moment, because that's been a big part of our journalism over the last few years. But we've talked almost exclusively about Cenovus, not about Enbridge. And Enbridge makes one claim that is common in the industry and needs to be debunked right now, because before I could say anything about what Asian electricity grids or what power grids are going to do or want to do, I had to go and interview experts. And so China and India and Malaysia and Vietnam, all sorts of them, and because they all burned a lot of coal. And the Enbridge claims that LNG exports with liquefied natural gas have a tremendous opportunity here to displace coal and reduce emissions.
Mhm.
And I have not found any evidence that Asia actually wants to do that or even talks about it. Now, I don't know where they
Yeah.
got their information. Maybe they're having private meetings with these power grid operators, but that is not the official government position of any of these Asian countries. And their position primarily is to either keep burning coal or to add, like as China is doing, enormous amounts of renewables and over a period of time make coal-powered power plants, coal-fired power plants, the backup.
Yeah.
And they'll have these high-efficient coal plants, and they will have a capacity market, so they get paid when they're not producing electricity. And if when the sun isn't shining and the wind isn't blowing, they'll crank these things up to as their backup generation. They don't want gas because they have coal internally, domestically, and they
Mhm.
have to import gas. So they don't want gas in their power grid. And so this claim, in my opinion, from what I've seen in my many, many interviews about Asian power sectors, is this is baloney. This is absolute created narrative in order to convince investors that there is a market for their product, when in fact there's no basis for the claim in the evidence.
Yeah, absolutely. And I think that's really underscored when you look at this really basic pricing across these energy types. If you compare coal to, taking Canadian gas and shipping it across the Pacific and landing it in East Asia, for example, you're going to see that for Canadian LNG companies to be, or for Canadian LNG projects to be turning a profit, they would need to be selling their gas at something like 5 to 6 times the price of coal, relative to the power that it's generating. And LNG does not compete with coal on price, and increasingly it does not compete with renewable power on price. So I think the notion that Canadian LNG is going to be fueling Asia through the future is wishful thinking. And I think just in addition to that, we've actually seen that materialize to some degree in the gas demand projections from a few years ago compared to now of the bulk of Asia has pretty much flattened off.
I want to put some numbers to this. A couple of weeks
Mhm.
ago, I interviewed a gas analyst named Purva Jain about India. And they do burn some gas. But she said they don't want to burn any more because in order for gas to be competitive against coal or renewables, it has to be $5.50 a million BTU.
Yeah.
And it currently goes, LNG goes for about $8 or $9.
Yeah.
And the gap between what the price it would have to be competitive in India and what it sells for and is likely to sell for going forward, given the high costs of liquefaction, the odds of this happening are very, very small. And they certainly don't support the claims that are made by Enbridge and others within the industry that this is a big opportunity and that LNG, in fact, can be competitive.
Mhm. Yeah, and I think we've seen that in action from quite a few countries as well. If you look through East Asia's power supply trends, they've been really bulking up investments into their nuclear power capacity. As well as if you head down to South Asia, we've seen multiple instances of local jurisdictions canceling regasification projects, basically saying, the prices of foreign liquefied gas are really high and they've fluctuated. And especially, I think one of the big pieces here is that during the Russian invasion of Ukraine, a lot of these gas prices absolutely spiked. And European nations in a bid to get off of Russian gas were saying, we're going to pay whatever we can to get whatever gas is available. And that came at a really crucial time as a lot of South Asian and Southeast Asian countries were looking at building out long-term energy procurement plans. And they ultimately, a lot of them said, we see a much smaller role for gas in our energy supply patterns than we really used to.
Yeah, I've raised it. And let's finish the interview this way, Michael. I've been raising the issue for years now, and arguing that the industry's plans to expand oil and gas production, build pipelines and other infrastructure is really built on a house on a foundation of sand. I mean, it's almost invented at this point because the pace of electrification in Asian economies, in particularly China, but increasingly in the entire global South, which includes Latin America and Africa and other places, is accelerating so rapidly that the IEA's modeling now almost looks conservative.
Yeah.
And this is not considered as a risk factor when the industry makes its claims that we need a pipeline, we need more LNG, we need,
Yeah.
and there are so many risks. I mean, stranded assets, environmental liabilities that aren't built into the business model. So who's going to pay for old wells or, that need to be done? All of these risks. Oh, and climate policy. We should put that because
Yeah.
China has an industrial emitters carbon tax. The European Union just brought in a carbon border adjustment mechanism, which is a carbon tax, and this is spreading around the world. None of these risk factors go into the claims made by the industry to the government. And here's the thing. The government repeats it. Prime Minister Mark Carney, this has been one of my bugaboos, he knows better than this. He knows that there are these risk factors. He's an economist with a PhD from Oxford, for crying out loud. Of course he knows this. Nobody considers it. Nobody talks about it. It's all just upbeat PR kind of narratives. And when I saw how I found out about your claim is one of the usual suspects, the oil and gas boosters, was complaining about it on social media, and it had no substance, and it's an attack on Canadian businesses. And I'll tell you something, Michael, that was the smoke that told me there was fire in that story.
Yeah.
As soon as I heard that, I knew it. And so I tracked you down and set up this interview because it's not the case. And risk is not being built in, and investors should know that.
Yeah, absolutely. And I think investors need to know that, which is why we asked the Alberta Securities Commission to crack down on this. The same way that investors expect genuine, accurate information in their financial statements and in their financial disclosures, they should be asking for genuine and accurate information from emissions disclosures, from transition plans, and from sustainability disclosures. And I think on the sort of the public end that you were talking about, ultimately, I think one of the big aims of the industry is for this narrative to be self-perpetuating, for Canadians to believe that this is our future, this is how we drive economic growth, this is how we drive economic sovereignty, and that then begets significant support from the federal government, expedited project approvals and environmental assessments, when ultimately I think our federal government and its provincial counterparts need to be smart about thinking, where is there growth in the future? What does Canada have that is going to be needed for the coming decades, as opposed to what has worked in the past and what is there big dollars supporting in the public narrative and in advertising.
That isn't happening. And in fact, the absolute opposite is happening because we're seeing reflected in the public comments by the Prime Minister and his cabinet ministers that they want Canada to become an energy superpower in both conventional and clean energy. And conventional means oil and gas. I mean, that's not a stretch. So this narrative that you talk about being self-perpetuating, it is already self-perpetuating. And public opinion polls already reflect that narrative. The opinion about pipelines, for example, are much more positive than they used to be because primarily that narrative. Anyway, Michael, this has been a great discussion. Thank you very much for this. Really appreciate it.
Yeah, thanks for having me, Markham.